you guys want to hear from really smart people that are, to me, to the left, because they're going to have a lot of wisdom in terms of what it takes to be a professional fund manager. So maybe you guys could just do a quick intro.
Hi, I'm Vishal. I'm with Next Legacy. We're an early stage venture fund of funds. We've been deploying capital in early stage managers since '99. Most of our capital are from philanthropics, athletes, and cultural luminaries. We have an early stage venture established manager fund of funds. We have an emerging manager vehicle, and we directly co-invest in companies sourced from our GPs. That's me. Hi. And yeah, I have a background in I used to be a trader. I was with JP Morgan, Citadel. I was with another fund of funds, but I've been doing LP investments for the past 5 years. Nice to be here.
Hi. I feel like we could have done this in Sonoma. I think half the room was there. Josh Porter. I started a fund a little over a year ago called First Look Partners. We invest in exclusively emerging managers, US-based emerging managers, sub $50 million funds and below. Did our first close in December, started investing. We've committed to 5 managers so far. Prior to that, my business partner and I were investors together at a large family office for a guy that started a big hedge fund in Chicago called Magnetar Capital. So have been doing fund investing since 2015. And yeah, what was your name?
Vishal.
Vishal. Like Vishal was also a trader prior to that at Point72.
Hi, everyone. It works. Thank you. Hello, everyone. My name is Youngra Kim, and following Josh and Michelle, sorry. I started my career as a finance industry, Goldman, as an engineer. And my first venture capital career was at Arch Venture Partners in Chicago doing deep tech investment. And then I did both fund and startup investment in a Japanese corporate. And now I'm running a fund of fund with a headquarters in Japan. Very similar to everyone here, our bread and butter is emerging managers, and our definition of emerging managers is first and second funds, sub $50 million funds. We're deploying out of our first fund. We back 10 plus emerging managers already. But we really started this program 3 years ago, and so we have some other additional investment in our balance sheets. Fund investment is really fun, a lot of fun, especially working with emerging managers is really fun. And as an investment product, I think there's a huge potential especially with emerging managers. Always, enjoy working and partnering with you and other LPs as well.
Hi, my name is Ian Park. Some of you remember me from KIC. I used to work at KIC, Korea Sovereign Wealth Fund, which managed about $200 billion. So I was investing a lot in Andreessen's and General Catalyst, the larger funds of the world, and realized that there's a hole in the market. They're becoming more private equity, more different asset, moving towards different asset classes. So I really wanted to work with the next generation of Sequoias and Andreessen's. So I wanted to focus on emerging managers. So now I'm with the Primer Sage. It's a VC fund, but we also have a fund of fund. So that's where I'm thinking about deploying similar strategy as Youngra. It's first fund and second fund, the smaller funds, more sector specialist. So that's what I'm looking for. Excited to meet you all.
So the first question I have is, there's a lot of knowledge and education around how to start your fund, how to do portfolio construction for fund managers. But there's a lot of people that are, exiting companies. They're angels. They want to become emerging LPs because they want more of a diversified approach. So someone that's kind of becoming an emerging LP, or even if you're starting your first fund to fund, what are some things that you should think about in terms of like portfolio construction, right? I mean, if you're thinking about a concentrated portfolio of funds versus kind of a more diversified approach, what are some of the exercises that you guys have put in your head in terms of like how many funds you should invest in, the fund size, kind of all that stuff?
That's an interesting question. For us, we've been deploying since '99, so the strategy has grown a lot.
Yeah.
On any given fund, we have about 24 funds, 2 relationships. In the past, we did emerging managers from within our flagship fund, and we just spun that out because we realized how amazing that opportunity is. Small funds, First-time funds have shown greater performance. We have a diversity lens as well in the emerging manager program, so we just spun that out separately. But I think the question on how many managers you have really depends on what kinds of manager you're backing.
Yeah.
If you're going to go for any sector-specific managers, then you might want fewer ones who capture the broader market. Or if you are generalist, you'd want to have more diversity at the end of the day. The value is being generated by the companies, and you'd want to cover most of them. So that should be the way you construct your portfolio. The other thing is there's a lot of the LPs start their fund of funds practice for to have some direct investment landscape. So it also depends that you need to have clarity on why you're investing, what is driving the investment factor. If you're doing it for direct, just mention that to the GPs, and that is how you'll create. You'll write smaller checks, many managers, to get as many deals as possible.
Sure.
So that's one way to look into your own portfolio construction as an LP.
Got it. It's helpful.
Yeah, agree. I think you sort of have to start with what the purpose of the vehicle that you're investing out of is, and then what product are you selling to your LPs? For us, I think like some of you guys, we leverage our manager portfolio to make direct investments in companies that break out of their portfolios. So we want to build a direct portfolio of, call it 15 to 20 companies, where we can leverage our managers' pro rata rights. Happy to go through an SPV to kind of share economics. But that sort of dictated our kind of portfolio construction in terms of we wanted more managers rather than a concentrated portfolio. Sure.
So I think there's two questions. First question is how, as an LP, to build the portfolio construction for their LP investment. My advice to the new LPs is do not follow FOMO and meet as many managers as possible, because there are a lot of managers, as we all know. We have more than 300, 400 exposures every single year. I meet 200 funds every single year. And as you meet more managers, you can build sort of the idea or insight or strategy that you are more comfortable, right? So I think it's really important to just try to meet as many managers as possible, just to find out the right ones, right? And from the manager, as part of the second questions, as a managers, I think a really important thing is when they talk to LPs, just to make sure that they have their own investment strategy. And when I say it's just cliche, but it's a real investment strategy, like why you think the investment strategy works than others. Again, there's a lot of managers, believe it or not. A common people is like a lot of managers say they don't have competitors, but I'm telling you, there are competitors. So just make sure that what you're selling, why yours is good, just have a deep understanding. Everyone has something, right? But it's about the articulation of the strategy. So I think just making sure that keeping that in mind is, I think, important.
I think it's also, I agree with you, all of your comments. One thing that I thought about is every fund of fund and every LP have their own agenda. Some LPs actually wants to do information only. Like some of the fund of funds, they want information from specialist GPs who are smarter than them and share the information with their LPs. I think that's one vehicle that you can think about. So if that's the case, your co-investment is not worth to them. They want your information, they want your network. So understanding the mandate of an LP is the most important thing. And the other thing I want to let the emerging managers know is that it's not about you, but it's all about the LPs. What I'm saying is that they don't like you because they don't think you're going to be a good fund, but they don't like you because they just don't fit into their investment criteria. So as an emerging manager, you just meet more of them. When you're evaluating startups, the startups has to meet a lot more GPs than what they think, because it's all about finding the fit. It's not about finding the best fund. It's not about finding the best company. It's just finding the right partner who's going to trust in you, who's going to believe in you, who buys your thesis. So my recommendation, again, is meet as many fund managers and don't take it personally. It's more about understand what they're trying to do as an LP and then pitch what they want to be. And at the same time, I also realized that I cannot accommodate all the LPs. You just need to pick your LPs too. So if you pick LPs because they have money, it's going to be a headache going down the road. So you got to think about your portfolio construction in terms of LP base too.
So two things that I always hear about is your edge and your durability, right? So that's just a repeatable model that you have, and it maybe evolves, in fund two, right? And it evolves for a specific reason, or maybe doesn't, right? So beyond those two things, what are some of the qualitative and quantitative things that have kind of gotten you over the line to actually invest in the fund?
Before that question, I really loved your point. I have included in my emails when I say no to managers, I've started saying that we are not a fit for your portfolio. I think that's a very well made point. On selecting managers, see, at the end of the day, we are doing venture. It's about sourcing, picking, winning, and value add. That is all it boils down to. And you have to, there are various managers who have edge in one, some have edge in multiple, but those are the qualitative criterias which you are trying to find the truth for when you're doing your diligence. Yeah. So you just have to work around it, and I think those are the qualitative metrics. Yes, you can look at the track record, but the entire process is to get the information about those qualitative metrics from that entire diligence process.
And a lot of those are table stakes at some point, right? The quantitative metrics, if they're hitting a certain type of performance, that's table stakes, right? So all you have is kind of the additional things that you've uncovered on top of that.
Additional things, and what makes an LP's eyes shine is you're very differentiated, and you've done that in the past, and it's showing value. If you're in 2005 and building a YC, everyone's like, oh, this is interesting. Let's invest in that. Sure. So if you have enough differentiation, that will help you. I think that is one thing I like to say to emerging managers or established managers is before you pitch to a LP, know who you're pitching to, what sort of exposure they already have, and what you will bring additional to their portfolio, and make your pitch accordingly, change accordingly. So I think that's a very well made point.
Yeah, it's helpful.
Yeah, all good points. I think a mentor of mine said this to me, who runs a very successful fund. He said, as you go out to think about your fundraise, remember that you're going out to family offices and high net worth individuals, and these people, this is their hard-earned money. They're going to be wiring that money to you, probably from their account at Goldman Sachs or JP Morgan, right? They expect the same level of service out of you that they're getting at Goldman and JP Morgan. And so I think for us, some of the qualitative stuff, because I agree, a lot of the quantitative stuff, all these decks start to look very similar, right? They all have the same, we co-invest with Sequoia and Andreessen and this and that. And so you start to think about other things, and it's how you communicate, it's your memos, how kind of robust are those, how, when you pass on founders, how do you treat them? And it's just a kind of level of professionalism, I think, that we kind of look for.
Sure.
Yeah, kind of all the similar points, but to Ian's point earlier, our mandate is to maximize our fund level return through the primary fund investment. So what we are looking for is fund managers who can drive the return as high as possible. So our qualitative and quantitative due diligence is built around that. So for quantitative, yes, we because I started my career as an engineer, I have a huge bias on this technology, how we can use the technology in the finance industry. So we actually built our internal system to compare the funds that we made to other funds we made in the past. But we use them not to choose where we are going to invest it in, but we use the system to filter out the outlier in either way, whether it's really bad or really good. So it's like a check mark, as Joel said, whether or not they're in the table stake, right? So qualitativism becomes more important, right? So we also take communication very seriously, because we are RIA as a fund of fund. A lot of fund of fund are RIA, and we are also RIA. And we have to have a certain level of governance and compliance and everything, right? So having cadence, a good cadence of the communication, the quality of the communication is very important. It can be form of phone, it can be a form of a written, email, but yeah, we consider those qualitative factors among many others important.
So, talking about communication, I posted on my Substack, which by the way is called Money Behind the Money. The first Money Behind the Money. Yeah. And the first point I made was reply first and respond later. So LPs love communication, and they want you to reply to their email as soon as possible and acknowledge that you received the email. And then you can respond later, a week after or something, because LPs has their bosses they have to report to. And when they send an email, hey, I sent an email to Youngrok, but he got it, he's working on it. It's better answer is than Youngrok hasn't responded to me yet. So the first thing I told all my GPs is that, can you just respond to me that you see my email? That goes a long way. And the other thing I was thinking is that you got to figure out what bucket you are in. Like LPs don't think about this like one by one. They are also building their own portfolio, like you're building your portfolio of startups. So you want to think about like what LPs are looking for. For me, I'm looking for sector specialists who are smarter than me. So I'm picking like 2 fintech managers, 2 space managers, 2 biotech managers. That's how I'm thinking about it. So you got to identify which bucket you belong to and pitch into that bucket. I think that's the one of the most important thing as well. The last thing I really love is that it's all about personal relationship too. Like I always think of, what am I going to get out of this fund? Am I looking for information? Am I looking for network? For example, I want to talk to somebody at Sequoia. Does he know somebody at Sequoia? Then I can just ask them to connect me to somebody at Sequoia. So it's either information, network, or return, or co-investment. I think it's one of those. And think about what you can add value to these GPs. And the last thing, it is very personal, is that whenever I pick an emerging managers, most of them usually don't really have a track record. I honestly don't really care about the track record because we're always looking for an outlier, like you guys are looking for an outlier in terms of startups. What I really look at is, do I really want to work for this guy? I mean, we're getting into 10-year relationship. It's worse than the marriage. So you can't even get out. So, so that's where I think, do I really want to work for this guy? Because this guy has to convince the founders who are better than me. So if I don't want to work for this guy under this guy's supervision or something, then this guy is not going to be able to convince the founders to take their money. So those are things that I care about.
Yeah, thank you so much. So I'm going to end the panel with one really quick question from all of you guys, but I wanted to add one thing to what you said. So this is something that I learned in my professional career. If somebody asks you point blank to answer a question and you don't know the answer, it's okay to say you don't know and that you'll get back to them. That's much better than trying to just respond and scramble and then the answer is really sloppy. So, it's, I mean, that's just one thing that I learned. Just kind of say, hey, you know what? Let me look into this and let me get back to you instead of trying to just, say something to kind of answer. But I want to end the panel with just one quick nugget of advice that you'd give fund managers in 2024.
That's $1 million question. Yeah. I mean, I already gave the major advice that know who your LPs are and approach accordingly, but I just want to made an additional comment is, LPs do like to add value. Just tell us what you need from us, basically. That's the major part of what my pitch here is. Ask the LPs, I want introductions to other LPs, say that we're gonna have reference calls, say highly of me. Just make the life of an LP easier and that'll make your life easier at the end of the day. That's a short, sweet nugget. Sure.
I think the best piece of advice I could give if someone was just starting out is to kind of think about when you set kind of your fund size, and your fund size is your strategy, but make sure that that fund size is something you think you can attainably hit, because I think the worst mistake that people make is kind of going out and, they think they need 50 for a strategy, and so they put that on the cover, and then they kind of, they don't have an anchor lined up, and so they start with 2 or 3 or 4, and it kind of looks like it's stalling, and suddenly like they go back to the market and say, well, actually it's going to be a $20 million fund, and then it's kind of like you've kind of backed yourself into a bit of a corner. So just kind of be intellectually honest with kind of where you think you can end up.
Sure. I think thinking through why emerging managers are starting a fund is really, really important. Like many years ago, I didn't think it's important, but now I think it's super, super important. And that actually helps emerging managers to think about their strategy, how they can win the market. If they cannot find a good answer on that, probably they should not do the emerging managers at all. I'm myself is emerging fund of fund managers, so I spend a lot of time thinking about why I'm doing this. And I still need to think more day by day, but I think it's really important to think through why you're doing this and why you need you can add one more VC firm in the world.
I'll talk about one thing that's very specific to 2024. I think your first close should be before the election. I think that's something that everybody thinks about. You don't know what's going to happen. So your first close should be, you have a closer before November, I think. And then let's go for January or February, because that's when the new budget's coming in. But this year is different. I think you got to close something before the election.
Great. Well, hey guys, the four of you guys, I just want to personally thank you guys for supporting the Sutton ecosystem and supporting all these managers and coming out. So thank you so much. Appreciate it.